Hello, everyone. Welcome back to Block Talk and the first ever podcast on this channel. Today, we're joined by a very special guest, Jez Mohideen, who is the CEO of Laser Digital and a key figure in the world of digital assets. In this podcast, we're going to discuss the impact of President-elect Trump coming into the White House, macroeconomic trends, and where the crypto and stock market is headed in 2025. Thank you for joining us today, Jez.
Thank you. Thanks for inviting me. I'm very, very happy to be out here.
So I've seen Laser Digital involved in numerous numerous ventures in the crypto industry, such as asset management, trading, early stage investing, solutions. Now, what exactly is Laser Digital, and what's your story in traditional finance, and what caused you to shift into Web3 and digital assets?
Yeah, my experience is I've spent the last almost 30 years in macro trading. I come from fixed income background, so pretty much macro is key to fixed income, understanding monetary policy, how the bond yields react to it. So therefore, that's my kind of foundation. From there onwards, a number of years spent in that, both on the buy side as well as the sell side. And I got to a point that for me, the innovation which coming through, particularly Web3 and digital asset, became a lot more interesting. Macro became directly trading, obviously fixed income. Macro became a little bit boring for myself. So for me, I was looking for something into innovation and something which driven by digitization. And the world is we are heading into a digitization in the digital domain. Even macro assets are going to get tokenized. So my view is that whether it's Bitcoin drives it or driven by financial assets, it's all converge into the same place. So that's kind of what led me into digital asset. I mean, my venture into digital assets started about 7-8 years ago when I was at the buy side Brevan Howard. And then kind of that interest kept me going. And when I came into Nomura about 7 years ago, while I was actually looking after parts of the trading, drove me to also incubate a few ideas within the bank, starting with a custody, because we felt that without solving the custody, how do you store the assets securely and safe? Very difficult when institutions come into a digital asset domain. So that was the first project called Komainu, and kind of that led for us to go further into the domain. And once the institutions got comfortable how we securely store the asset, then the rest of the applications, which is very similar to the rest of the macro assets that go into obviously trading, asset management, and so forth. So Laser was actually incubated out of Nomura for the same reason. Again, we want to be in the forefront here of digital assets or digitization of traditional finance. And therefore, Laser was created to kind of solve that or fill that gap. Today, if you look at Laser is actually institutional, I would say institutional deep liquidity provider and solutions and parts of asset management. Where we come with a lot of institutional DNA, but coming to the crypto domain, really, providing the bridge between TradFi and native digital assets. So there is actually a void, because a lot of crypto firms very difficult get onboarded by traditional firms. Similarly, traditional firms find it very difficult to directly actually liaise with the pure crypto firms. So we are kind of, I would say, the conduit, both solving that bridge.
So to start off with the macroeconomic landscape, we've seen overall a net negative impact on financial conditions over the course of the last few months, because we've seen since what was meant to be the Fed pivot back in September, when the Fed started cutting rates and the easing cycle started with a 50 basis point cut. We then saw another 50 basis points being cut over the course of the November and December Federal Open Market Committee meetings. The yields on Treasury bonds have actually been rising while rates have been coming down, due to markets pricing in inflation reigniting because of rates coming down. And concurrently, since Trump's election win back in November, the dollar index has been rising, which is also a which is also considered negative for financial conditions and risk on assets. Now regarding the timing factor, we are at a similar time to when the dollar topped out following Trump's election victory back in 2016. The dollar topped out in early January of 2017. We're now in 2025 January. So what are you seeing regarding rates, yields, and the dollar in the near future?
Yeah, I mean, there's no question that the Fed had similar issues coming into 2024, 2023. Powell was very dovish, and then the inflation numbers didn't deliver the Fed's expectation. If anything, inflation numbers were sticky, and some of its seasonality as well, Q1. So they delayed the rate, obviously cut all the way to almost summer, which was almost kind of led by the big, carry type of a market incidents we saw early August. Kind of led the first kind of aggressive rate cut, and there onwards, obviously, we've seen further 50 bips cut. Overall, when I was looking at the macroeconomic conditions, the monetary condition, also is the monetary condition restrictive or not? I didn't think, I don't know. My view was Fed was a bit too aggressive. Markets didn't need rate cuts, particularly, I think as much as they did. But obviously, they were worried. Inflation's, they were worried about obviously liquidity conditions. They were worried about obviously financial conditions, and also kind of around August, they were also worried about. They were not as worried about inflation. Inflation was coming off. Obviously, seeing almost double digits and coming all the way down to 3 handle. And their expectations were seeing what's happening in Europe. Probably we're going to go into 2 handle pretty easily, and kind of settle down to the long-term inflation rates. But I didn't think, looking at the kind of financial conditions and also how the stock market risk assets are behaving, liquidity conditions, it was that restrictive. I mean, they very quickly found out after the first cut, and then obviously they committed to the September cut. They very quickly found out that. Obviously they were also shocked by it. When I look back at it, shocked by some of the payroll data. Obviously, you saw pretty poor payroll data in August as well, which kind of led them. But the thing is, payroll's been a bit volatile, and it has stabilized where it needs to stabilize between 150 200k or 150 250k. But inflation numbers, you saw actually coming off all the way into kind of August, September. It's kind of almost steadied up, and we are starting to see a little bit of uptick more recently. That's starting to obviously, it's reflected in obviously markets' reaction. From Fed's minutes, obviously came as recently as last week, which was relatively hawkish. And they are getting a lot more comfortable with the fact that they don't need to cut anytime soon, which is, I think, fair. Looking at the risk asset, despite we've seen the rates at 5%, 5.25%, and then it's come off obviously 100 bips. Stock markets at all-time high. It's in December we hit there, and I don't think it has come off very much. So, still risk assets start trading extremely well. I mean, obviously we have seen a little bit of probably 7 to 10% movement, but that's nothing. We are talking from an all-time high. I mean, it's more obviously. We are seeing the effects of into liquidity condition, particularly like into crypto and Bitcoin. A lot more markets are nervous, but I think overall, my personal view is 4.25% is still easy policy. So it's easy enough that it's not restrictive. So where does the Fed go from here? I think right now market's pricing in a cut now all the way. It's kind of delayed up until October. So summer is when market thinks it's starting. Obviously, seeing the pretty strong payroll and some of the sentiment numbers we saw on Friday as well. Markets corrected further. I think markets calling this relatively right. I think delaying the cut up until then is right. Now, of course, there are other variables which could affect the markets. I think when you look at inflation, I don't think after the COVID supply shock we saw, now more recently it's demand-led. I can't see the inflation going far below 3%, 3.3. So which means probably the Fed's long-term rates probably we will hover or converge to about 3.75. Another 50 bips at max, Fed may be able to go. initial market thought it can go all the way to 3%, which is another 125 bips. I doubt very much. At most, probably another 50 bips if you get it this year. There is some forecast, including our institutions, calling for even a hike tail end of this year. So some institutions. But I don't think they will change. The course is more likely you're going to see either no hike or no cut, or at best another 25 to 50 bip cut. But there are other variables, which unforeseen variables now. Trump coming in has significant impact in the market, for sure. One of the issues why Fed and other central policymakers have been a bit cautious, particularly for US, it's first-hand, it's inflationary. That's what the market's been focusing on. Fed is also worried about because all this tariff increase is inflationary. So that's already talked about by IMF, Fed, and so forth. Now, that's the, I would say, positive, tailwind for the inflation. But then the other side, what markets not focusing too much, which could pivot the Fed's kind of hawkish stance, is that there's a lot of talk about government spending cuts, sort of austerity. Obviously, Elon Musk has been talking about it, and the numbers they're talking about, if they were to deliver, that definitely will slow things down. That may be something which could keep the Fed under check. So if there is that sort of austerity measure, if they push through, which I kind of doubt at this stage, but if they push through, because all the talk about efficiency, which also means, making the government efficient, but they're going to cut spending, right? So the numbers they're talking about, if they achieve them, then that could slow things down, and Fed may have to give leeway for further cuts later on in the year. So all in all, in terms of bond yields, the front end has been fairly stable because obviously Fed's in an easing mode despite hawkish. So 2-year notes have been hovering right now 4.25%. 10-year notes 4.75%. Obviously, we've gone from all the way to 4 to 4.75%. My personal will get to about 5% at best, and then it kind of slows down. The reason behind that is a lot of liquidity in the market at the moment. I mean, if you look at even front end, if you look at the bills and money going to Treasury, the front end is almost 4 to 5 trillion, right? It's a significant amount of liquidity is out there, searching for yield. So I can't see yields going below 5%, because quite a lot of it's driven by the fiscal easiness. People thought, obviously, Republican as well as Trump may go through. That's also driven. So curves have been steepening significantly over the last month and a half. 2 stands now nearly 40 bips. It's come from flat. So it's kind of pricing right part of the curve. But I think you need to watch what happens in the government spending side of it. That will determine long-term yields, my view is. But on the back of all this, I think dollar strengthening probably coming closer to end, I feel. Probably this quarter we will see the highs, or maybe even this month for that matter, into inauguration as it slows down. There are other factors also could ease off inflation, which also need to take into account as well. So that could be also supporting kind of easing inflation pressure, is that geopolitics. For instance, solving issues in Ukraine could significantly impact the commodity price, particularly the gas and oil. So stability, rest of the Middle East, all this could actually ease up. Whether it's commodity, obviously, prices, or supply, demand, logistics, all these are affected by the geopolitics as well. So that could be good. And the other issue is, Trump administration is talking about deregulation, tax cuts. This could also obviously fuel the other side of the part of the equation as well. So many factors are coming. Generally, a lot of positive factors, because deregulation, tax cuts, actually good for consumer. While also kind of stabilizing the world and less focus on kind of geopolitics, and that could ease up as well, kind of generally global, I would say, risk sentiment.
Last month we saw a cut, although inflation has been sticky, and you could make the argument that the markets are dictating what the Fed does in terms of monetary policy, as in to avoid significant corrections or crashes in markets such as the S&P or the Nasdaq, where a significant portion of people in the United States keep their savings and their money. It's not in the Fed's best interest to see a deep pullback in asset prices. Would you agree that we see that markets tend to dictate what the Fed does? Of course, what the Fed does impacts the markets, but we generally see, apart from a few exceptions like what we saw in 2022, in that tightening cycle, would you agree that generally it's the market dictating the Fed's monetary policy stance?
Yeah, I mean, this is an argument that's been going on for a long time. I mean, the last 25, 30 years I have heard this. But from my understanding, Fed is given a kind of dual mandate, right? Growth and inflation. So that's the only thing they look at. Yeah, they are less worried about financial markets, and of course they will react, because if financial market corrects aggressively, they look at, actually, because it affects consumer sentiment, it affects everything. Monetary conditions or financial condition gets restrictive, borrowing rates goes up, particularly the credit worthiness, credit cycle gets tighter. So one impacts the other. As opposed to, I think they're worried about, because, even if you look at the Fed's dot plots, it keeps just changing. It's very volatile, right? So obviously that has an impact on where the markets take rates, and they look at it and they kind of plot and they come up with it. But there's no real, exact science in it, because they take the median plots and the markets react to it. So it is a kind of vicious circle. But markets, at times markets know better what is restrictive, what's not, and it actually pushes, the rates to the right level. And but if you look at even the markets, a lot of the time wrong, right? I mean, it's the last year, soon after the Fed, obviously kind of indicated they were going to cut, emergency cut of 50 bips. Market on that day, it was pushing for almost intra-meeting cut on the day cut, right? Market started pricing. Obviously, Fed didn't react to it, but they reacted aggressively with the first 50 big cut. At that point, market was pricing 300 basis points of cuts, 3% cut. So we're talking about taking all the way down to, 5.25 to all the way down to, almost 2.5, 2.25. I mean, which is way too aggressive. I mean, we may not even get half of that. So markets will push the Fed. But Fed's kind of used to this, and at times they are late to react as well, right? I mean, you saw in the GFC and all that, they will react post events, right? Because a lot of the time I see them reacting post big events as opposed to pre. They don't take much insurance as they should. They're very bad at taking insurance ahead of big events. They rather react afterwards, kind of seeing the market impact. So of course, if big correction in risk asset comes through, they had to evaluate how the shock it comes to the rest of the economy, right? Whether it's financial conditions and the risk sentiment and how it impacts. Then they react through the feedback loop.
Yeah, it's because there's also what's known as the Fed put, which is the belief that anytime we see a crash in assets, the Fed will be there to step in.
Yeah.
In terms of loosening monetary policy, quantitative easing, whichever monetary policy tool they intend on using. But that is generally what people go long on financial assets with the belief that the Fed will be there to step in and protect asset prices no matter what happens. Do you believe that?
Yeah, I mean, Fed puts there. Maybe we see significant correction in the financial risk assets of, let's say a stock market, or they will react, right? There's no question, because it has a feedback loop. It's not just looking at the financial asset. Certainly financial asset going down affects people's spending power, right? To your point, a lot of the consumers in the US heavily invest in stock market, unlike Europe, right? The percentage ownership is significantly higher. Most of their 401k plans are in quite a lot of heavily invested in equity. So because monthly when they get statement, it has a direct impact on their own. So it affects the consumer sentiment very quickly. So, yeah, I mean, certainly, Fed put is there because it's a contagion effect has in the U.S. because the average person is quite heavily invested in the stock market. So and it has significant impact on the rest of the economy. So, therefore, yeah, Fed puts generally has worked. Yeah.
Yeah. And do you see Trump is, of course, a pro-growth president, as we've seen in his last run, but do you think that the spending cuts in the with the Department of Government Efficiency, the goal is to increase efficiency and to cut back on spending? Do you see that as something that which could negatively impact the GDP and economic growth, or is there another way you could look at it as this would boost investor confidence in the US because if they, for example, have a surplus, which they haven't had since 2001, it's been a deficit for now 23 years. The government's been running a deficit. How do you?
Yeah, I mean, there's no question he's pro-growth. For particularly, if you look at the history, he's very much driven by how the risk asset performs, how assets around his administration does. I mean, almost he takes a stock of how the stock market performs on a day-to-day basis. Yeah, the whole idea of creating the Department of Efficiency is to create efficiency. So, but they have commented some aggressive numbers in terms of spending cuts, because obviously to balance the deficit issue they have on the other side, because otherwise governments are always under pressure to shut down because of obviously the deficit ceiling, so debt ceiling. So I mean, for me as well, that's why it's not as clear today how it's going to work out. For sure, the whole idea of creating that for efficiency. If Elon managed to get the efficiency, he's talking about how he's run some of his companies. Definitely, that's the positive side of it. Now, with that, if he can compensate some of the significant benefit efficiency through cuts, then it kind of, I would say, the net if it is beneficial, then it's great. Then actually it should be positive GDP, positive for growth and all that. But it's not as clear at the moment how that's going to work because it's quite new.
Yeah.
So one has to see how that's going to work. Markets are paying attention to the austerity cuts yet, although few economists are calling it. We need to see how it impacts, and I'm sure Fed is monitoring that as well. But kind of numbers have been just free floating at the moment. But we have to see how that's going to work. But yeah, the whole idea is to create a Department of Efficiency means create efficiency in government services, in the public sector. So if we can achieve that, and within the next few years, certainly that could be very, very positive, because that's one thing in the last administration when he came in, deregulation, we saw through in certain sectors he opened up. Similarly now, he's talking about even digital assets, AI, by pointing even the crypto AI czar. That's the right thing, right? Because putting experts to kind of really mobilize and bring the kind of the disadvantage US has had in some areas because of heavy regulation, to bring that back, the advantage back to the US.
Yeah, and the way I think about it is Trump, he measures the health of the US economy based on the stock markets, and this time around he'll be measuring his sort of acceptance rate, or how people are reacting to his presidency, in the price of Bitcoin. I think that it will be a challenge to get growth up, keep inflation down, rates down, stock prices high, all at the same time. Would you agree with that?
Yeah, I mean, it's ultimately you can't address everything, but for sure, if he does things, particularly deregulation, tax cuts, solving geopolitics. If I put like the kind of the top three issues he can address day, kind of I would say day 1 to day 180. That actually could be very positive, both for risk assets and generally. Now, that also means that the Fed will sit back. They don't need to act, aggressively. I don't think Fed rates are as restrictive for them to act. If some of these easing measures, particularly deregulation, tax cuts, if it comes to that boost, generally the consumer sentiment, consumer spending power as well, right? Because so that's for me. If that comes through, that should lead the way, because that's probably what he will be focusing on, and then bring efficiency part of it as well, right? If some of these things come through, then that will be a lot more beneficial, and then kind of rates market kind of calms down a bit. Because at the moment, it's trying to figure out, the Fed is on the move. Then, of course, long-end yields are under pressure because of fiscal situation, and which is what you're seeing in the UK as well, significant spike on long-term yields because of the budget, since the budget. So I think they need to get that right. I think they're aware of it, and US is generally better at this.
So, if the so over the course of the past 60 days, markets like risk-on markets, so assets such as Bitcoin, the Nasdaq, the S&P have all been consolidating, or they've not been. We haven't seen any significant or deep pullbacks under such harsh financial conditions, which is of course due to, like we already mentioned, the rising yields and the rising dollar. Because when the dollar rises, the global liquidity, for example, would start to contract, because global liquidity is balance sheet capacity to absorb the creation of new financial assets. Do you see the dollar topping out? You already mentioned that you see the dollar topping out at some point in Q1 or potentially even January, as that would.
That's my central thesis. Now I may get it wrong by a few months, but I think I think yields are running its course, in the sense that long-term yields, for me, another 25 bips gets kind of attractive levels. You'll see a lot of real money asset managers are going to kind of, already the long yields at 35%. So I think it gets attractive in the current conditions. That could slow things down for dollar as well overall. And I mean, I don't think US also wants to see a much stronger dollar, because obviously they won't be in a competitive advantage as well. So in the past, I remember last time around as well, when Trump came in, he was heavily threatening Japan and others, kind of on the back of the strength of the dollar. So there will be obviously discussions about the dollar, but I personally think dollar is going to top out soon. Dollar's got own other issues, but that's something it'll be interesting to see more geopolitics, how they're going to solve kind of de-dollarization as a long-term trend, right? Whether Trump or not, that's a different, particularly China, the BRICS having their own say, and then talking about China and Russia, talking about obviously different payment systems, and obviously different benchmarks for global reserve balances and so forth. But that's a very long-term topic. But on the back of all that, I just feel the dollar's had a very good run. I think it may have a bit more, but I think getting closer to the end, my view is. In terms of risk assets still very close to all-time high. Even Bitcoin, when you look at it, what is it? We're 10% from the highs after doing almost 3.5x last year. So it's the right thing, as you say, consolidation. It needs to consolidate. It's good. Actually, consolidation is always healthy, because that actually allows people to rebalance portfolio, reevaluate what the right levels are. What you don't want is the straight line, because it's never a good thing. I wouldn't be surprised. Another 10% correction, it probably may even be better. But obviously we have the inauguration coming up, and new administration startup. So there's a lot of positive things to look forward to, and see how digital asset. I mean, this is a big year. It's a big year for digital assets, because obviously last year was a significant milestone, was ETF and the institutional adoption. Now, of course, with Trump administration particularly focused on both digital asset and AI, you're going to see that kind of some of the, I would say, stock market strength may come from that, right? AI is a big theme, right? I mean, it's a mega trend. We may see the next 5 years huge kind of growth upside coming from AI.
So how do you see markets reacting in the short term to Trump's inauguration? You think we see a sell-off, or?
I think I personally think, generally the markets at, where we are close to the all-time highs. So markets are going to kind of stabilize. Obviously, we've seen a bit hawkish Fed tone as well as strong data. We have CPI next week, so obviously it may further validate some of the strength in the inflation. If it does, we may see further correction. And then going the inauguration actually is better footing going with some correction. Overall, market will go positive into it because, general things he may say may be generally positive, both in terms of deregulation, tax cuts. These are positive tailwinds. I actually think so. There is decent amount of tailwinds we may see. Some of it the market's priced in, but saying that, I actually think we may see further upside in Q1 on the back of the positive momentum, which we may, see through the Republican administration.
So right now, Trump, you think he'll focus on slashing regulation and boosting innovation?
For sure. Yeah, I mean, that's the central mandate he got elected, because deregulation, he said, for one new regulation, he wants to get rid of 8. He may not get all kind of in numbers, but I think general is pro-business environment, right? And also he will put significant pressure on the rest of the world to equalize some of the disadvantage. I mean, if you look at crypto land, right, over the last particularly 2 years with the SEC significant scrutiny, despite the scrutiny, we've seen the institutional adoption, right? I mean, we got to say that how well the markets have done. I mean, despite significant pressure the industry as a whole has had, we still saw SEC approving the ETFs, right? Which is a massive milestone. With that, we have seen large institutions, like you're seeing a skyrocketing of institutional adoption. So you've seen BlackRocks of the world, you saw Boni, State Street, Fidelity. These are large, mega institutions adopting digital assets, right? So that happened during very, kind of, I would say, tough regulatory environment where there's lack of clarity at times, but at times, it's kind of harder regulatory condition, particularly in the U.S. So what you saw, U.S. was kind of some of the U.S. entities operating with kind of disadvantage to the rest of the world, some parts of the world, whether it's Asia, Middle East, and so forth. But now they're going to, this typical Trump, he will bring back some of the advantage back to the U.S. So not just Bitcoin, particularly in the altcoin space, which I'm more bullish on, areas of DeFi, because central thesis of, if you look at crypto, is not just, Bitcoin is the base layer, right? We call it digital asset, kind of, digital goal or base benchmark. Beyond that, real innovation to, why even I got involved in the crypto is that the kind of the entire thing of decentralized finance, right? That's the real innovation coming out of blockchain, Web3, and so forth. So the DeFi is something obviously there's a lot talked about, because that's where a lot of the regulatory real bottlenecks exist because of the decentralization or KYC, AML. So I think some regulations around that, clarity around that, could heavily speed up the entire adoption of the digital asset by the mainstream.
So I think 2024, the biggest accomplishment, which is institutional adoption, and we've had buying pressure coming from institutions, MicroStrategy as well. Overall, I think Bitcoin and crypto went from a contrarian trade to a consensus trade. Would you agree with that?
Yeah, I tend to agree. I mean, with that, what you saw is it's become more mainstream asset. Yeah. People may not call it a macro asset here, but it is a mainstream asset. Now, of course, BlackRock, clear evidence is, what we have seen in the ETF, right? The ETF, within a year, it achieved more AUM than the entire gold ETF had in 10 plus years, right? So it just tells you the kind of the both retail and the institutional adoption as a mainstream asset, right? So that's the kind of the benchmark.
Yeah, I saw the BlackRock Bitcoin ETF now has around $57 billion in AUM, whereas the BlackRock's gold ETF, which is now nearly 20 years old, has about $33 billion in assets under management. So that's definitely And then,
Yeah.
of course, you have Trump, who is pro-crypto, pro-business. Do you see Trump building the Bitcoin strategic reserve? Because currently the US government holds it's nearly $20 billion worth of Bitcoin that's being held by the US Marshals Service. And do you see, my opinion is, or my view is, I think Trump, the least he will do is transfer the Bitcoin that's being held by the US Marshal Service to the Treasury. Do you see him buying any more Bitcoin beyond that point? Because recently we've also seen he's been focused on taking back the Panama Canal in Greenland. Do you see him putting any focus on Bitcoin?
I think what he would do is, I mean, it's a difficult one to call because obviously he's put a lot of experts into this, right, including CryptoZar. And he's got SEC, more favorable people, and very knowledgeable people in the administration, particularly the people who's backing them. And he's getting a lot of support from big crypto founders as well, for sure, and the family himself, right? Eric Trump is heavily involved. I mean, he's in the crypto or digital asset ecosystem, particularly on the decentralized finance and so on. So for sure, I mean, obviously he stated in August that he wants to make it a strategic reserve, particularly the holding, whatever the Marshals are holding. In terms of buying new Bitcoin, I actually think it'll be great if it happens in his administration. That's a significant step, huge step. Instead, I would say the seeded amount from the Marshals will be held as a strategic reserve, and then there will be discussions around how do they grow that, particularly seeing some of the other governments are looking at this, and also some of the other corporates are now looking at it, like MicroStrategy. There's a number of presentations going into large tech companies, the financial tech companies, saying that this needs to be included in their corporate balance sheet. So when that discussion happens, I actually think it kind of, strategic reserve argument becomes secondary. If the government is supportive, they're not selling. Because if you really look at the last 6 months, a lot of the pressure prior to the, obviously, November, a lot of the pressure from June onwards to about, I would say, September, even in Bitcoin, came from supply pressure from, like Mt. Gox, US government potentially selling, German government selling. It's all selling pressure, right? So if you take that away, that's a positive, tailwind for me. You don't need the kind of the, US saying, we're going to buy X amount of Bitcoin per year and all that. Instead, where he may deregulate significantly, allowing miners, he wants to obviously use, support the miners heavily, right? So supporting that, giving sort of tax incentive, that could be very beneficial, right?
Yeah.
Getting back actually the advantage and getting, a bit like obviously Silicon Valley, actually really getting the crypto kind of ecosystem, whether it's in Austin or parts of the US, giving incentives to people to come and set up and grow, a bit like what you're seeing in the, obviously in the UAE, right? If that happens, that could be significantly beneficial as opposed to focusing purely on the reserves, because I think he'll be, their effort will be well spent on that, as opposed, because Bitcoin, we understand the supply very clearly. There's limited supply. There'll be plenty of buyers over a long period of time. I don't think you need the government to come and completely, buy and restrict. Kind of, I would say, put, contraction in the supply. Whereas if you kind of give incentives and if you allow deregulate for companies to come and operate, I think it'll be a significant tailwind. And then corporates also gradually including their balance sheet. But that itself, that demand itself will keep going.
Yeah. Because the way I think about it also is Larry Fink, he's been talking very positively about Bitcoin. BlackRock has their own ETF, like we mentioned. He's almost become the chief marketing officer of Bitcoin. And Trump, when he spoke at the Bitcoin Nashville conference back in July, he raised one of the biggest raises he's ever done for his campaigns, all donated to him by Bitcoiners who he knew are the people that you want to be on your side. Because Bitcoin, it builds, the longer you hold Bitcoin, the more conviction you have in it, because you go through all of the 70-80% drawdowns after 1,000% gains. in the bear market you have those drawdowns, and that's where the conviction is built in Bitcoin holders. So I think he definitely wanted to get the Bitcoiners on his side, and it would be very disappointing if he didn't go and build that strategic reserve, because I think recently we've seen a lot of concerns about whether he'll do it or not, because he's been talking so much about Greenland and the Panama Canal, and MicroStrategy, they of course have now over $40 billion worth of Bitcoin on their balance sheets. We've also seen many other companies consider, Microsoft was considering it as well, putting it on their balance sheet. They of course didn't. Now we're starting to see the corporations adopt Bitcoin gradually. Then you think we go into governments?
Yeah. I mean, there's for sure some governments are looking at it. Obviously already we've seen one of the Asian governments are looking at the strategic reserve. I think way they may approach a strategic reserve, I'm just trying to think how could the US attack, because it's quite a pivotal moment if they adapt, not just saying it's a strategic reserve, what Marshals have, and go beyond that. The path they may take could be very similar to countries like UAE is taking, that using some of their surplus energy to mine. That's what I mean. So they could directly go, as opposed to they could start, obviously mining, using some of their, some of their excess energy and all that. So that could be one path. That'll be a significant path if they do, because there is a real reason for that, because the cost of actually, there is a significant benefit. It's not just going and buying from the market, right? Similar to obviously Marshals as well, because that's actually they gain from seizing assets, right? So similarly, that's the significant benefit for the taxpayer. Similarly, mining has a benefit because obviously they're using excess energy and areas of Texas and all that. You could see that, which is what it'll be interesting to see. If that happens, I actually think then that's a huge tailwind, and the price action could transform the entire industry. And then you're going to see some of the other, obviously starting with some of the emerging market central banks adapting faster. But obviously that it provides more stability for them, particularly even in an environment where the dollar comes under pressure, kind of de-dollarization, and their own domestic currency is under pressure. So they're the ones who could adapt faster, the smaller kind of emerging markets, and then gradually you may see some of the larger. If US paves the way, typically you'll see others following. It's only a matter of time.
Yeah.
So that'll get priced in very quickly.
I've said that the BRICS, the countries in the BRICS are, I think if the US does it, they'll also, because they're trying to compete with the US and beat them to what they do, we might see those, so Brazil, Russia, India, China, South Africa, as well as a few others. Now the UAE is also a part of that. I think if like you said, if the US does it, the rest will follow, and they might even try to outdo the US in the amount of Bitcoin that they buy.
Yeah, for sure. I mean, that's for me. Yeah, I mean that's the central thesis how this entire reserve conversation continues. I mean, it's just not obviously sovereign reserves, then obviously corporate balance sheet reserves. These are, I mean, it paves the way, right? That is a central discussion now taking place, which is significantly positive for the asset class, right? I mean, with the limited supply you have with Bitcoin, but then beyond that, entire crypto, right?
Because the Fed Chair Powell was asked in the December FOMC meeting if they would consider buying Bitcoin. He said that the Federal Reserve is not allowed to own Bitcoin. Do you see that changing at any point?
Yeah, I mean that's a large, it's a lot more lengthy discussion. It will take a while. I think they'll probably try to attack the low hanging fruits because that requires reg changes. Kind of more constitutional discussions they need to have. But significant benefits when they talked about, as I said, first, of course, once you call it a strategic reserve, how much you have becomes irrelevant, right? Because
Yeah.
then it is strategic reserve. It's a matter of time, then over a period of time,
Yeah.
how much you accumulate,
Yeah,
right?
it's just the fact that you
That's
have
right.
the strategic reserve,
That's
which
right.
obviously then
Yeah.
boosts investor confidence
That's right.
in the asset, because now people are still scared of the volatility and owning Bitcoin in general, the potential risks. We saw BlackRock released a video explaining what Bitcoin is, and it said that the supply will not always be fixed. There's a chance it's not always fixed at 21 million. The way I think about that is that it's just, as such a large financial institution, they have $11.5 trillion assets under management. They have lawyers telling them to include this and basically every potential risk that you have. And it's like if you bought the S&P in the 1980s, for example, you bought it very early and you're also considered crazy, but then it's only a matter of time before you're considered a genius. So. And with decentralized finance gaining traction as an alternative system, what potential challenges do you see with decentralized finance integrating with traditional finance markets?
Yeah, I think the biggest challenge which we are facing as well, which because we are a significant believer, when we set up Lays as well, that we are significant believer on-chain finance, right? So reality, on-chain finance brings significant benefit in terms of trust and transparency, in the sense that today, as financial institutions, if there is a bank run, really there's opaqueness. You don't know. Whereas on-chain, you can see, you monitor wallet, you can exactly see how much every second's moving, right?
Yeah.
And then things like innovation around AMMs also brings automatically the risks are getting unwound. So a lot of the DeFi, if you really look at it, it didn't come under pressure same as the centralized systems, right? The whole idea of centralized system having single nodes is fragile by nature. When you have multi-nodes, then naturally it becomes less fragile. And that's what obviously decentralized finance is trying to bring about. So, and I think that's extremely positive. And also with that, you also brings in terms of liberalizing, and obviously frictional cost becomes less, transparency becomes. So for me, DeFi is the way forward. That's one of the central theses why we are here, in the sense that in digital assets, the next phase of adoption. But one of the challenges DeFi has is today the biggest challenge it has is that solving the I would say the KYC AML aspect. When you have how do you avoid how do you control the tainted pools? How do you actually there is red flags in terms of actors participating in certain pools? How do you get it? It doesn't mean in the traditional finance, things are as transparent that they act much faster. But here, because of the fact that you're allowing everybody to participate, it creates that worry for any regulator, but there are ways, of course, one thing is you whitelisted, pools, you can participate versus not whitelisted. But the whole idea is when you start whitelisted, when you fragment liquidity, that loses the real meaning. So you may see institutions getting involved in multi-step, right? So particularly whitelisted pools, I would say, KYC or whitelisted actors in a pool, DeFi pool, so you can participate almost indirectly. It's like a permission pool, right? And then, at certain stage, when the technology is sophisticated enough to actually, figure out, certain pools, pool monitoring systems become sophisticated enough, you can, figure out, which is already a number of technology exists out there, elliptics of the world, you can use to understand a pool is tainted or not, to what degree, so you can use thresholds and reduce. So, yeah, the biggest challenge is, again, for regulators and institutions, it's the KYC AML. And once that, actually, the number of technologies being built today, that gets resolved, I would see significant adoption. Now, the other issue is obviously large traditional finance firms this is very disruptive for them, right? So natural stance for them is that they are scared, some of them, where this is going to head. While also they have the resources to also start going heavy into it, right? A number of large financial institutions looking at it today. They have pilots within their financial institution how to go about how to build, and then how they are starting to interact and discussions with the large, I would say digital asset entity. So that's the critical bit. My view is that the further adoptions on-chain finance, on-chain asset management, on-chain risk management, on-chain trading, which is already we are seeing the DEXs, how DEXs are, at times actually dominate in terms of volume, and it has less systemic risk compared to SEXs, right? So a lot of good things to come. I think still there's a certain amount of innovation needed in how to monitor these pools, and that's coming through as well, very positive. With that, you're going to see larger financial institutions kind of bridge that gap. That's why entities like us are here. We are trying to kind of solve for that as well.
Thank you for joining us today, Jez. And thank you to everyone for watching.
Thank you. It's been a pleasure, talking to you. Thanks very much.